Hello, this is Chuck Carvel. I'm the Chuck in the Markets Up Chuck. And today's post was titled Earnings Determine Market Price. And the idea behind this is that, in reality, for the long-term investor, the most important thing is earnings. Ultimately, wherever the earnings of a company go, the stock price is going to go. So I developed this tool years and years ago that allowed me to test that thesis by correlating a company's long-term stock price to its earnings. So I'm going to start with kind of two what I call bad examples. If you start with Eastman Kodak here, and this is a 20-year chart, you can see that during the first, half of the chart here, earnings were kind of erratic and stock price was erratic. But I want you to notice that since 1999, Kodak's earnings have gone straight down. And as you can see, as a long-term investor, their stock price has gone straight down also. Eastman Kodak is clearly not a buy and hold company. And then the next chart I brought here, I've shown before in past posts, is Dun & Bradstreet. There was a period here in the first 5 or 6 years where earnings were kind of going up and stock price, even though volatile, followed that. Then we had this huge collapse in earnings and a huge collapse in stock price. And there's kind of a little hump in here, and stock prices kind of followed that. And then for the last 7 or 8 or 9 years or so, earnings and growth has been very, very good. And as you can see, Eastman Kodak stock price has followed earnings. So clearly, there is a relationship between earnings and stock price. Now I'm going to introduce a new concept on this relationship between earnings and market price, or one that I've actually talked about in previous blogs, but I want to clarify, and that is that there are really, in our research has proven and shown that there are really 3 classes of growth rates that really matter in relationship to earnings and market price. The first is for companies that are growing at around the 5% level, as I talk about in my written part of the post. Companies that are growing about 5% have to make an adjustment because very high quality companies are worth more than 5 times earnings. When you're dealing with faster growing companies above 15%, you use a P equals growth rate. When you're dealing with slower companies under 5% in general, or around 5%, General Electric is a classic example of that, you make what we call a Graham-Dodd adjustment. Ben Graham, the founder of Modern Portfolio Analysis, as well as the mentor to the likes of Warren Buffett and many others, wrote his famous book, Security Analysis, and he talked about the fact that any company was worth about 8.5% or 8.5 times earnings, and he developed a formula which utilizes a base of 8.5 times earnings, then he has some multipliers. And rather than get into the long formula, we've developed a chart that allows us to make that adjustment. So when you're looking at General Electric, even though it's only growing by 5% a year, using the Graham-Dodd adjuster, you can see that, and typically a lot of times you'll see very high quality companies like General Electric growing at these rates. I want you to notice that the stock price correlated to this Graham-Dodd adjusted multiple. In this case, we're looking at around a 19 to 20 multiple of earnings. But the point I want to get at is just look how earnings and stock price with this adjustment follow. Look at the overvalue period you had, and then how the stock price came back, and then it followed earnings again. And then now that we've come to this recession and earnings have fallen off, once again, you can see the importance of earnings, and General Electric stock price fell off as well. My next example would be 3M, and again, you have this Graham-Dodd adjustment. I want you to notice how the stock price follows this earnings adjusted with the adjusted price earnings ratio, and you can see when the stock price is above this line, it gets overpriced. What we're really trying to do with this tool here is try to make assessments of whether the stock is a good investment or not. And when I see the stock price above these earnings justified lines, whether it's the Graham-Dodd adjusted or a straight chart like I'll show here in a few moments, these are times that when I know that I'm taking more risk for a lower rate of return. Simultaneously, when I see periods where the stock price is below that, these are exciting periods to buy. So for example, if I look at this company, 3M, as I point out, we have a 5% growth rate. It started undervalued and ended undervalued. I'm going to assume we're going to get a very similar rate of return. If I go down here and check that, I get a 5.9% compounded rate of return, which correlates to the company's growth rate, but is also adjusted by, with the price-earnings ratio that makes sense. So 3M, a 5% grower, gives you a 5% rate of return. If I go on and look at another example that's well known, would be H.J. Heinz. It's about a 4.5% grower. I want you to know you can see a clear period of overvaluation here. You can clearly see that any time you can buy the stock when it's below its earnings line were reasonable times to buy it as long as earnings held up. Here it was below earnings, but earnings fell, and that still wasn't a great time to invest. Now, we have it undervalued. The key would be let's forecast the future and see what we think earnings are going to be like. But I want to make the real point is look how the price and the earnings correlate over this period of time. 4.5% growth rate, leads to a 3.2% rate of return, and that, lower than growth rate adjustment is simply the undervaluation that you see or the stock trading below its earnings justified line. Now, for my next category, I'm going to move on to companies that are growing at around 10% or so, a little faster. And here we end up with the Graham-Dodd. Anything above 8.5%, we end up with a Graham-Dodd plus an earnings-determined market price adjustment that you see here. And you look at McDonald's, it's an 11% grower. But I want you to see how the price correlates. Once again, I can look at this tool and use it to help me determine whether the stock is reasonably priced or overpriced. Overvaluation becomes very clear, and undervaluation becomes very clear. And normal valuation is something that we, make an adjustment. But anytime we can buy it close to normal valuation, we can expect rates of return that are going to equate to the company's growth rate. Here we have an 11% grower, 10.9% grower, you end up with a 10.7% rate of return to shareholders. Earnings determine market price. The ratio between earnings and market price is critically important to the long-term investor. My next example in this thing will be Hershey's. Once again, you see this very, very strong relationship between earnings and market price. Periods of overvaluation are very clear. Periods of undervaluation become very clear. And, you can see that there's a long track of earnings. Here we have about a 7.5% growth rate. And when I go down here and check that against its return, about a 7.9% long-run rate of return. It's the rate of change of earnings growth and the valuation that matters, which I'll be talking about in my post on Monday, that is the rate of change of earnings growth that ultimately is going to determine the return that the shareholders earn over the long run. And then finally, my last example in this thing will be McCormick & Company, the spice company. You can see very strong earnings growth, a very strong correlation between stock price and earnings growth, about 11% grower, somewhat undervalued at this stage in game, started out a little bit undervalued as well. So you get up with about a 10% rate of return, 9.9% rate of return that equates, again, very closely to the earnings growth. And again, you can see the relationship between earnings and stock price over the long period of time here. Now I'm going to move on to faster growing companies, companies growing at 15% or better. There you use what's called a PEG ratio, or price earnings ratio equal to growth rate. Here's Jacobs Engineering grew about 18% a year. Look how closely and how strongly stock price is correlated to that. We had this period of overvaluation here, and then, of course, the stock price eventually comes back to earnings. I'll be talking about that again more on Monday. Now you have an undervalued stock, but you've got an 18% growth rate, and when you check it against its rate of return to shareholders, about a 17% rate of return to shareholders. Very consistent to its earnings growth rate. My next example, the P equals growth rate, is ResMed. I've shown this stock before. You can clearly see a very strong relationship between a very fast 29% grower, periods of overvaluation, which are very common for companies growing this fast. It's currently slightly undervalued, so this 29% growth rate gives us a 26% long-term rate of return. But once again, the relationship between earnings and market price is undeniable. So there you have it, the importance of earnings in the investing process. Earnings do determine market price over time, and it's that rate of change of earnings that can really be useful in helping make strong, successful long-term investment decisions. If you find a 5% grower, for example, you can expect a 5% rate of return. But by the way, I didn't show it here, but you can, maybe expect some dividends from that company. But you would be looking at a very high-quality company. The faster the growth rate, the more risky the investment theoretically gets. However, you get 8 or 10% growers, you're going to get 8 or 10% rate of returns, and then you can only expect very, strong long-term growth rates from companies that are growing real fast. Don't ever underestimate the importance of earnings, and through earnings we can explain an awful lot about investing, as we've done in the past and we'll be doing in the future. This is Chuck Harneveld saying, thanks for listening. I'll be taking the weekend off as usual. On Monday I'm going to bring in the equation of valuation, which I think is very important. I look forward to doing that presentation. Hope you tune in on Monday. Over the weekend we'll be posting a couple of oldies but goodies. You might want to check those out as well. Thanks for listening and have a great weekend.